From Black Monday to the dot-com bubble burst, history has peppered us with moments of panic in the financial markets. Each time, fear grips investors, prompting many people to hit that panic button and flee from stocks. But what does the data tell us about the long-term impact of these financial downturns? Let's take a look at this chart. It tracks the performance of $10,000 invested in the S&P 500 from 1959 until the end of 2023. Now notice those panic buttons at the bottom. Each one represents a significant drop of 30% or more. And despite these black swan events, the overall trend is upward. So what's the lesson here? Market volatility is a fact of life, but reacting to the short-term fluctuations with panic can be costly. History shows us that time and time again that staying invested over the long haul actually pays off. Those who weathered the storm and stayed the course were rewarded with long-term growth. Don't just take my word for it. If you've been a long-term successful investor, feel free to leave a comment below. I'm sure that they'll tell you that having a diversified portfolio through the ups and downs is going to pay dividends along the way, but it may not feel like it. Let me show you how this works over time. So what we're looking at here is the S&P 500 and a diversified portfolio. We're defining the diversified portfolio as 60% stock and 40% bonds. And so we're looking at $100,000 invested from 2000 to 2023. Let me show you how you felt along this ride along the way. So from 2000 to 2002, the S&P 500 was down 40.1%. The diversified portfolio was down 15.7%. So if you look at the right here, your feelings about this is that you lost money, so it didn't feel good. From 2003 to 2007, the market was up 82.9%, and your diversified portfolio was up 91.5%. You're happy the diversification actually worked, but this doesn't happen often, so let's continue. 2008 happens, the market's down 37%. This portfolio is down 28.5%. You lost money. Doesn't feel good. You're ready to hit the panic button. But remember, you're a good investor or a great investor, so you don't do this. Let's see how it looks next. From 2009 to 2019, the S&P 500 was up 351%. The diversified portfolio was up 237.2%. You didn't make as much money. That's how you're feeling. And then Q1 2020, we all remember COVID happening and we saw the fastest decline in the market. It dropped 30.4%. And then the globally diversified portfolio was down 24.2%. Again, you lost money. And then Q2 of 2020 through 2021, the S&P was up 119%. Diversified portfolio only up 69.8%. And I say only up, but 69% is a great return over that time frame. But again, you're feeling like you didn't make as much money. And then 2002, you ended the year in the S&P down 18.1%, and your diversified portfolio would have been down 15.3%. Again, you lost money. Does investing even work? Well, let's look at 23. The S&P 500 ended the year at 26.3%, and your diversified portfolio was up 15.9%. You didn't make as much money as the S&P. You feel like you lost. But now let's look at the total from 2000 to 2023. That $100,000 invested grew to $490,770 if you were invested in the S&P 500. But remember, look at those swings on this chart here. Very high highs, very low lows. The diversified portfolio, even though you felt bad along the way, except for that 1 year or few years, the diversified portfolio was up $491,430. You actually did better, even though along the way you didn't feel as good. So diversification can work even when it feels like losing. So I'm here to tell you, if you're not feeling good about your investment experience, you're probably doing the right thing. In conclusion, the price of panic is steep. While market downturns can be unnerving, they're also a part of your investing journey. You need to look at the volatility as the fee you pay to be a great investor. By understanding the historical context, maintaining long-term perspective, and resisting the urge to panic, you can navigate market volatility with confidence. Thank you for joining me today. If you found this video insightful, don't forget to like and share, and also subscribe for more content on smart investing strategies. Until next time, happy investing.